down roughly 30% from the recent top. Caught between two opposing narratives. On the surface, price looks calm, range-bound, indecisive. On the surface, price looks calm, range-bound, indecisive. Underneath, pressure is building. As I'm recording this, Western spot sits around $82, futures around $82. Shanghai spot near $88, Shanghai futures near $90. That's roughly a $6 sustained premium in the East. That premium has not collapsed, it has held. And when one region consistently pays more for physical metal while another region sets price through paper markets, that disconnect doesn't resolve quietly forever. Now let's look at the data. COMEX registered silver just fell below 100 million ounces for the first time in modern tracking. Registered inventory now sits near 98 million ounces after nearly 5 million ounces drained in a single session. At the same time, March open interest sits around 65,000 contracts, roughly 325 million ounces in paper claims. That's about a 3.3 to 1 ratio of paper to registered physical. First notice day is approaching. Now let's separate two conversations, technical and structural. Technically, on shorter time frames, silver lost the 150 EMA on the hourly chart. That level failed to hold as support. As long as price remains below it, it acts as resistance. For short-term traders, that matters. Momentum traders have reason for caution until levels are reclaimed. But technical signals operate on short horizons. Structural signals operate on longer ones. The Silver Institute just confirmed a 6th consecutive year of structural deficit. Forecast deficit, approximately 67 million ounces. Investment demand rose about 20% to roughly 227 million ounces, a 3-year high. India alone is projected to import roughly 220 million ounces, close to a quarter of global annual mine supply. Industrial demand remained strong, recycling increased, mine supply ticked up slightly. Yet for 6 straight years, demand has exceeded supply. That's not a headline spike. That's cumulative drawdown. Now zoom out further. China's holdings of U.S. treasuries and dollar assets have been trending lower over more than a decade. Whether gradual or strategic, the direction is clear. Less dollar concentration, more diversification. When large economies reduce dollar exposure, capital reallocates somewhere, often toward commodities, strategic resources, infrastructure, or domestic priorities. At the same time, global uncertainty indicators are elevated. Corporate bankruptcies are higher than in recent years. Consumer defaults have risen. Job openings have cooled. Yet precious metals remain strong over longer time frames. That combination, economic strain alongside commodity strength, is typically associated with currency pressure and supply constraints, not economic boom. Now layer in timing. Shanghai markets close for roughly 8 days during Lunar New Year. That temporarily removes a major physical demand center from active trading. During those periods, liquidity dynamics shift. Western markets often see thinner global participation. When Eastern markets reopen, premiums and spreads become very important to watch. If Shanghai premiums remain elevated or expand after reopening, it reinforces the physical demand story. If they compress sharply, that tells a different story. Watch that carefully. Now let's talk delivery dynamics. March open interest remains significant relative to registered inventory. Will contracts roll forward? Will more stand for delivery? Will cash settlement reduce pressure? The system has tools. Delivery stress doesn't automatically equal failure, but high paper-to-registered ratios combined with sustained physical premiums create a setup where small shifts in behavior can have outsized effects. That's not hype. That's mechanics. Now let's balance this. The bearish case is real. Technicals weaken short term. Contracts can roll. Cash settlement mechanisms exist. Economic slowdown could reduce industrial demand. Paper markets have absorbed tightness before. The system has proven resilient over decades, but the bullish case is equally measurable. 6 consecutive deficits, strong investment demand, significant Indian imports, elevated Eastern premiums, COMEX registered below 100 million ounces. High paper-to-physical ratios ahead of notice day. When multiple pressure points align, structural deficit, geopolitical diversification, persistent premiums, inventory drawdowns, it becomes something worth monitoring closely. Not chasing, monitoring. Here's what matters next. Watch first notice day behavior. Watch whether March contracts roll or stand. Watch Shanghai premiums when markets reopen. Watch whether the 150 EMA is reclaimed or continues acting as resistance. Watch inventory trends daily. Technical signals say caution in the short term. Structural data suggests tightening underneath. Geopolitical positioning suggests long-term resource prioritization. Those are three different time horizons. This is not a trade signal. It's not a prediction. It's an environment. Do your own verification. The Silver Institute reports are public. COMEX data updates daily. Shanghai pricing is transparent. The investors who survive long-term are not the loudest. They're the ones who separate emotion from data. Silver right now isn't about hype. It's about structure versus price. And eventually, structure and price reconcile. The only question is when. Your capital, your decisions, your responsibility. Invest with discipline, not noise.